share with you how I'm restructuring my six-figure dividend stock portfolio. In fact, I even sold a little bit of my British American tobacco, MIMO, this morning. I'm going to break all of that down and where I'm putting that money. So ladies, gentlemen, I look so forward to breaking this down for you. Let's jump right into this.
Drop it.
Welcome back, my passive income investors alike, and yes, I adhere to the great Buffett's advice that your portfolio is like a bar of soap. The more you handle it, simply the less you're gonna have. So I want to start by sharing with you my portfolio overview and the thoughts that are kind of taking me down this path, and then we'll jump into the individual brokerage accounts and show you exactly what I've done. So consider slapping a like for the transparency, and let's get right into this, guys. So first of all, the part of my portfolio I am the happiest with is information and technology, which makes up 30% of the portfolio, being Microsoft, Apple, we got Tesla and Facebook in there, and I'm going to adjust this slightly, but by far I am the happiest with those positions and that asset allocation. The second part of my portfolio I am by far the happiest with is my utility segment, which makes up 16% of the total portfolio. And going into this crash, it's become very apparent that utilities are not only really boring to most people and undersought, but they're incredible performers and dividend payers through these horrific times. Right now I'm sitting on 3% cash, but I can actually minus that out from here because that's not really indicative of what I'm trying to show you guys. Now, taking a look at those consumer discretionaries, that would be my MO and BTI. They make up 16% of the portfolio, but 28% of the dividend income. Now, this is the part of the portfolio I'm shifting around a little bit, and I'm going to explain to you why that's more about how they're allocated between my different brokerages accounts, more than it is about like me not thinking it's a good company to be holding, because I still love those companies and they will be a forever hold in my portfolio. But I want to start focusing on the ideas that I have this year, which are primarily the real estate sector, but I'll get to that in a sec. Now, taking a look, 11% of the total portfolio right now is made up by financials. That would be my BNS, my Canadian Imperial Bank, my Wells Fargo. Nonetheless, I wouldn't mind scaling this up a wee bit, only primarily due to the fact that financials right now are really beaten up, and I think there's some really good value plays. Now, taking a look at the two parts of my portfolio that I primarily want to focus on right now in this restructuring is my real estate sector, making up 9%, and my healthcare sector also making up 9%. Now, if we take a look at the real estate sector, though, it's making up 27% of the income, and I'm actually comfortable with this, and I plan on making it a much larger segment, and that is only primarily due to the fact of the value I see in the real estate, specifically the real estate investment trust market. And because it's only 9% of my asset allocation, I feel like I can extend a little bit more risk and kind of build up that cash flow. Now, the healthcare sector of my portfolio is only Johnson & Johnson, and I don't want exposure to any other healthcare stocks, if I'm being honest. I do own MindMed, but I don't really include that as kind of like a full spectrum stock to be scaling up to like a $20,000 position. I do believe that, however, for Johnson & Johnson, and right now it alone makes up 9%, but I want to scale this up by leveraging down perhaps Facebook. And let me get into the brokerage accounts to show you why I'm having this thought process, because it's very localized to what is going on in these individual accounts. So we'll start with the healthcare sector here, because as you guys can see, I hold Facebook in my registered retirement savings plan, and I got kind of screwed over this year because I over contributed. I had to pull some money out, and I actually bought the majority of my Facebook stock outside of this account. A fairly scaled position at this point, but I want to kind of core focus my registered retirement savings plan on the two stocks I like the most in here, which is Johnson & Johnson and Tesla. Now, I'm very happy with the Tesla position, not so happy with the Johnson & Johnson. And the only reason I'm not happy with J&J is because I want more exposure to healthcare. I just don't know what other healthcare stocks I like other than this stock. So what I'm going to do at some point, not yet, but in the near term future, I am going to liquidate this entire FB position because, like I said, I got a lot of it already, and I'm just going to dump it into J&J. I am going to do the same with Wells Fargo. I mean, I'm not down terribly in this account on it. I only hold $300. It's nothing. It's not even a drop in the pond. Getting scale and diversification is a very big challenge for me right now, looking at my risk tolerance levels, but I honestly think J&J is one of those ride or die stocks every investor loves, and I would much rather make it one of the largest positions in the portfolio. Now, it is not by far the largest yet. Keep in mind, I think Apple's my largest position at 12,000 US, or about 17 to 18,000 CAD. Now, this isn't the biggest deal in the world, guys. I'm only moving $1,800. I'm going to be profitable on it, and keep in mind, that is all profit that I pulled out of Tesla in the first place. So Tesla's just the gift that keeps on giving here. Now, let's move into my RBC account. Now, this is my newest brokerage account, and what I've gone ahead and done is I've actually sold off BTI and MO. Completely just sold them off. I didn't make money. Actually, I should be up money because I was up on BTI, down on MO, but I've been collecting dividends for some time. So if anything, I broke even. Now, the reason I sold these is because, again, I'm already at scale. I only sold a couple thousand worth of those two combined stocks. And I mean, again, guys, take a look at the asset allocation. It is 16% of the total portfolio. So to pull back a couple thousand is probably barely going to take it to 15%, in which I'm actually going to take that money and I want 100% core focus it on my real estate investment trust right now, which is Ryokan. And if we take a look at like BTI or MO, their dividend yields are pretty impressive right now. But the other reason I think it's a great time to do this is in this account, I'm fairly flat on those positions, and Ryokan is just getting slaughtered, paying out a very similar yield in that 9.5%, 10%. Plus, Ryokan pays out a monthly dividend, which is another reason I'm finding it ever so attractive. So what we should see happen here, guys, is my consumer discretionary should irk down a percent or two. My real estate investment trust should kind of itch up to about 10 or 11%. And if I scale down Facebook, inch out a percent or two off my technology stocks, and then scale up an inch or two in my J&J. And then finally taking a look at it, everything should be scaled in a very nice, healthy manner. And then finally, my goals for the year is really to start core focusing, like I said, getting that real estate investment trust aspect of the portfolio to probably about, I'm going to say between 13 and 15% total. In fact, not yet, but soon I'm thinking about scaling MO even down in this account to re-itch up Ryokan. And then at that point, I would be very happy with the amount of personal money I've allocated to Ryokan. And then I even plan on extending this one step farther by utilizing debt to finalize the position. Now, I'm not going over all my brokerage accounts. I hold Ryokan in my TFSA. It's all over the place, right, guys? So I'm kind of jumping back and forth. If you want to see the full portfolio breakdown, you got to join me here every single Friday where I will fully update what I'm talking about today. But nonetheless, at some point, I really want to sell MO out of this other managed account. And then that way, my brain won't be as scattered either, because as you guys know, when I'm kind of calculating my dividend income, I'm literally holding the same stocks in multiple portfolios. What I would like to do is core focus them, scale them up to the positions where I'm extremely happy, and then start focusing on my new goals. I'm still going to use dividends in my other accounts to continue to buy into the financials, but with my own current money, I want to find a new stock to start buying after I'm done scaling Ryokan, because at that point, I would be extremely happy with the way that everything is allocated in here. All my allocation assets would be over 10%, with my highest allocation being in what I would consider my recession-proof dividend stocks, being in my utilities, my consumer discretionary, and my healthcare. And then my more at-risk plays that I've highly focused on during this crash will have been real estate and financials. And then ideally, I would like to move on with my life and start looking into stocks that I talk about all the time on this channel, talking about things like Scott's Miracle-Gro, Waste Management, maybe 3M, start exposing myself to new sectors in the market, and start having some fun, guys, because it does take a while to get these positions to $10,000 to $20,000 allocation sets, which I know to new investors probably sounds like a challenge, like holy crud, this guy's throwing 10, 20 grand a stock. He's only holding like 13, 14 positions, but that is what I am generally comfortable with. And I would love to know what you think about this in that comment section below. But stay cool, slap a like, stay awesome, and I'll catch you tomorrow.